Have you ever wondered why so many people struggle to grow their money, even when they know they should be investing? Welcome to MoneyAha, where finance finally makes sense. On this channel, we do the research for you, break down complex financial ideas, and help you make better decisions, without hype, without noise, and without confusion. Today, we're diving into the biggest investment mistakes everyone makes, backed by real research, behavioral science, and insights from some of the most respected investing books ever written. By the end of this video, you won't just know what not to do. You'll understand why these mistakes happen and how to build a smarter, more disciplined investment strategy that actually works. Let's dive in on number one. We have letting emotions drive investment decisions. One of the most common and most damaging mistakes investors make is letting emotions control their actions. People panic during market crashes and sell at the worst possible time. They get excited during market booms and buy when prices are already high. This behavior is explained by prospect theory, developed by psychologists Daniel Kahneman and Amos Tversky. Their research shows that people feel the pain of losses about twice as strongly as the pleasure of gains. The researcher Kahneman and Tversky, Prospect Theory in 1979, explained why investors often hold on to losing investments too long, sell winning investments too early, make decisions based on fear and greed instead of logic. Markets reward discipline, not emotional reactions. The goal isn't to eliminate emotion, that's impossible, but to design systems that protect you from it. What to do instead? Have a written plan. Use predefined rules. Automate where possible. Emotion is the tax most investors don't realize they're paying. Mistake number two is trying to time the market. Many investors believe success comes from knowing when to buy and when to sell. The problem? Even professionals consistently get it wrong. The book A Random Walk Down Wall Street by economist Burton Malkiel explains that market movements are largely unpredictable in the short term and often driven by information no one could foresee. Multiple studies, including research by Dalbar, show that the average investor significantly underperforms the market because they chase returns and exit during downturns. So timing the market sounds smart, but staying invested is what actually builds wealth. What to do instead is focus on time in the market, not timing the market. Consistent investing over long periods beats perfect timing almost every time. Our mistake number three is commonly poor or no diversification. Putting too much money into one stock, one sector, or one asset class is another major mistake. Diversification isn't about maximizing returns. It's about managing risk. Nobel Prize-winning economist Harry Markowitz introduced modern portfolio theory, showing that combining assets that don't move the same way can reduce risk without reducing expected returns. Concentration makes you feel confident when things go well, but diversification is what keeps you alive when things go wrong. What to do instead? Diversify across asset classes like stocks, bonds, real assets, sectors, geographies. It won't make headlines, but it will protect your capital. Mistake number four, ignoring fees and taxes. Fees quietly destroy long-term returns. A 1% difference in fees may seem small, but over decades it can cost you hundreds of thousands of dollars. John Bogle, founder of Vanguard, emphasized that costs are one of the very few things investors can control. In the book, The Boglehead's Guide to Investing, it emphasizes taxes matter too. Frequent trading often leads to higher short-term capital gains taxes and additional transaction costs. What you keep matters more than what you earn. What to do instead? Use low-cost index funds or ETFs. Trade less. Think long-term. Efficiency compounds just like returns. John Bogle, founder of Vanguard, emphasized that costs are one of the very few things investors can control. Mistake number five is overconfidence and underestimating risk. Most investors believe they're above average. Statistically, that's impossible. Behavioral economist Richard Thaler showed that overconfidence causes investors to underestimate risk and overestimate their ability to predict outcomes. Overconfidence was a major factor in events like the 2008 financial crisis, where investors assumed housing prices could never fall nationally. I say confidence is good, but blind confidence is dangerous. Instead, measure risk realistically. Stress test your assumptions. Ask, what if I'm wrong? And on number 6, we have underestimating the power of compounding. Compounding is one of the most powerful forces in finance, yet many people delay investing because they think small amounts don't matter. They do. A modest return, compounded over decades, can outperform aggressive strategies started too late. I say the biggest enemy of compounding isn't low returns, it's delay. Instead, start early. Invest consistently. Reinvest earnings. Let time do the heavy lifting. Number 7, chasing hype instead of fundamentals. Hot tips, trending stocks, and viral investment ideas attract attention, but rarely lead to sustainable success. Benjamin Graham clearly distinguished investing from speculation on his book, The Intelligent Investor. If you don't understand why an investment should generate value, you're not investing, you're guessing. Hype fades, fundamentals endure. Instead, focus on earnings, cash flow, balance sheets, competitive advantages, and long-term value creation. On number 8, we have failing to rebalance. As markets move, your portfolio drifts. Without rebalancing, you may take on more risk than you originally intended, without realizing it. Rebalancing forces you to sell assets that have grown too large and reinvest in underweighted areas. Rebalancing is disciplined investing in action, buying low and selling high without emotion. Rebalance on a schedule, annually or semi-annually, based on your long-term plan. Number 9, not having a written investment plan. Without a written plan, every market movement feels like a crisis or an opportunity, and both can lead to bad decisions. Research consistently shows that people with structured plans are more likely to stay invested and achieve long-term goals. A plan turns uncertainty into strategy. Instead, write down your goals, time horizon, risk tolerance, asset allocation rules, then follow it. The biggest mistake is ignoring your own psychology. The market isn't your biggest enemy. Your own behavior is. Biases like loss aversion, herd mentality, and anchoring influence decisions more than most investors realize. Behavioral finance research consistently shows that awareness combined with systems leads to better outcomes. Great investors don't outsmart the market. They outsmart themselves. Use automation, rules, and long-term thinking to protect yourself from emotional mistakes. Investing isn't about predicting the future. It's about building systems that work even when the future is uncertain. That's the mission of MoneyAha, where finance finally makes sense. We do the research, we simplify the complexity, and we help you make better decisions, one insight at a time. If you want clear, research-backed finance content designed to actually help you grow, subscribe to MoneyAha, stay curious, and let us do the research for you. Because better information leads to better decisions, and better decisions build better futures.